Into Commodity Central. I'm Ankita Saxena, and let's talk about how the commodities are faring at this juncture. In fact, if you look at the oil prices, now remember, oil had seen that gaining streak, the 2-session strong gaining streak that was above 2%, has cooled off a bit. Now remember, we did see the oil prices easing slightly today as traders are gauging the potential of supply disruptions after U.S. guidance of vessel transitioning. The Strait of Hormuz kept attention squarely on the tensions between Washington and Tehran. Now, Brent crude futures are down 25 cents or 0.4%, and that's hovering around $68.79 a barrel. And as far as WTI is concerned, the futures are down almost 23 odd cents or 0.4% at $64.13 a barrel. Now, that's after the price rose, like I mentioned, more than 1% yesterday when the U.S. Department of Transportation's Maritime Administration advised U.S.-flagged commercial vessel to stay far away from Iran's territorial waters. Now, as of now, oil is seeing a bit of a cool-off after that uptick that we saw coming in. And as far as precious metals are concerned, we do see gold and silver also coming off their highs. In fact, gold is trading down 0.7%. Briefly, it had ticked down from the $5,000 mark, though it has inched up a little. It's still trading with cuts of 0.7%, and silver is also down 1.3% at $81.13. So that's how the precious metal is also faring at this juncture. But let's talk about the other topic that we are going to be talking about, and that is the steel prices. Now, Indian steel prices are soaring on raw material costs and policy boost. But how is this going to shape up the industry demand and so on? Let's get on board Hemant Dewangan, who's the AGM PIC Big Mint, who's now joining us to weigh in on that. Hi, Hemant. Good afternoon, and thank you so much for joining us.
Hemant. Hi, Ankita. Thank you so much, and very good afternoon.
Right. Hemant, so the steel prices have jumped from 5-year lows to a 20-month high in the start of just very recently. So, is this a start of a new fresh upcycle, or are the retail investors really getting into it a bit too late?
So basically, I will tell that steel is very cyclic in nature. The prices are very cyclic in nature, and generally it goes down in the monsoon, and then it starts whenever there is a November end or December, it starts an uptick. But this year is a very different one because it was into the 5-year low. So steel prices for rebar and HRC was around 47,000 per ton, and now its HRC prices are around 54,000 per ton, and rebar prices are around 58 to 59,000. So rebar is a champion product in case of steel. Why this has happened? Because of the good demand from the project industry. So blast furnace route steel manufacturers are the biggest player in this. Basically, this is not a late or this thing, because steel is a very good fundamental product, and it is used all over through the year, apart from the monsoon season. So it is not a delay, but there is a huge demand upcoming from the both government and the private sectors.
Right. Hemant, also, what's really driving the steel prices right now? It's policy changes like safeguard duties, or just the rising costs such as an expensive coking coal?
So basically, the coking coal cost, which is the major contributor of the steel cost vertical. So if we see, the coking coal is around 33 to 45% of the cost contributor for the overall for the blast furnace manufacturers. Apart from that, coking coal prices has been year on year increased by 30%, and most of the coking coal has been imported from Australia, either from US or Canada, maybe Russia. So this particular is a major factor in terms of both HRC and rebar as a product for the blast furnace route manufacturers. However, the policy shift which is imposed for 3 years, that is implemented by the Ministry of Finance for next 3 years. That is additionally a 12% safeguard duty, which is impacting the flat product. So if we compare the cost of flat product, import cost, landed cost is around 56,000 levels, and domestic prices are around 54,000 levels. So there is a gap of 2,000. Above 56, if the domestic price will go, then there will be the import viability, and then import will be open for the country. As far as the import figures are concerned, this is a 13% drop on year basis. So in 2025, it's around 9.6 million tons of import for the country.
Right. Even also with the companies raising prices again and again, is there still money to be made in steel stocks, or could the buyer push back, start limiting the prices and therefore profits?
So, Ankita, very good question. But the thing is, we being Bigmin, we are neutral and unbiased to any of the industry because we are associated with both buyers and sellers. So basically, if we see, we are comparing technically it's on the EBITDA per ton. When the companies are releasing the EBITDA values, we get it technically on the per ton basis. So the EBITDA per ton value for the last quarter, quarter three, was around 5,000 to 13,600 levels for the major producers, and for sure the EBITDA per ton value will be increased in the Q4 of the particular fiscal year. Talking about the realization, because the price has increased sharply due to the raise in the rebar prices, because rebar prices were around 47,000 level and currently into the 58 to 59,000 level. So there is an increment of around 10 to 12,000. So coking coal and other raw material pressure is there, but cost apart from the cost impact, price realization is more. So EBITDA per ton value technically will be increased in the Q4 of this fiscal. But the fundamental of the company and other valuation need to be checked. That can any equity research company can tell about that.
Right, Hemant. On that note, thank you so much for taking the time out and joining us in ET Now. We'll let you go on that note, and it's time for us to slip into a short break. On the other side, we'll get you more updates on the market. Stay tuned.